Welcome to the deep dive. Today, we're cutting straight to the core of company valuation. And maybe more importantly, how companies actually build and, well, keep lasting value for shareholders.
Yeah, and our thinking today is really shaped by this pretty comprehensive guide from the consultants at McKinsey and Company.
Right. It draws on their work on valuation techniques, management strategies.
Exactly. And what's really striking is the author's experience. We're talking over 85 years combined in consulting, financial education. They've seen a lot. They've seen what works.
Absolutely. And for you listening, maybe you're trying to get up to speed quickly. Our goal here is really to pull out the most important nuggets from this big resource, no fluff.
We want to give you those kind of aha moments, a shortcut to understanding what really makes companies tick value-wise.
So what's the main message? The big takeaway from their guide?
Well, the fundamental idea they keep coming back to is that companies thrive by creating real economic value. And that happens when they invest capital wisely and get returns that are consistently higher than what that capital actually costs them.
Okay. Simple but powerful.
It seems simple, but the implications, they really ripple outwards.
Okay, let's dig into that fundamental principle then. Value creation. You're saying it boils down to this. A company invests money.
Right. Capital.
And the return it gets, that's the ROIC, return on invested capital,
Right.
needs to be higher than its cost of capital.
Precisely. And they frame this not just as theory, but as a universal truth. Doesn't matter the industry, doesn't matter where in the world.
So every dollar invested needs to bring back more than that dollar cost to borrow or obtain.
Exactly. If it doesn't, you're essentially, well, digging yourself into a hole, even if revenues look great on the surface.
And the main tool for figuring this out is discounted cash flow.
DCF.
DCF, yeah. It's
Right.
key. It lets you take all those expected future cash flows.
And sort of collapse them into one number today. What's it worth right now, considering risk and time?
Okay, that makes sense. But here's something interesting the guide mentions. It's not just actual performance that drives shareholder return.
No, it's performance versus expectations. That's crucial.
Ah. So if a company does better than everyone thought,
Shareholders tend to get returns above what they could have gotten elsewhere for similar risk. That's the opportunity cost of capital.
and if they underperform expectations,
The opposite happens. Lower returns. It's about the surprise factor, in a way.
which leads to a common trap, right? Just focusing on earnings.
Exactly. People equate accounting earnings with value, but the guide warns against that. Focusing too much on just earnings or earnings growth.
Can lead you astray.
It really can. You might make decisions that boost short-term earnings, but actually harm long-term value creation.
They have an example, don't they? Value Inc. and Volume Inc.
Oh, yeah, it's a great one. Two companies, identical earnings, same growth rate. You'd think, okay, similar value.
But no, Value Inc. trades at a much higher PE ratio. Why?
It comes down to cash flow and investment rates. And those are driven by ROIC.
Okay.
Value Inc. just generates more cash
Yeah.
because it doesn't need to reinvest as much capital to get that same growth. Its ROIC is better.
It's more efficient with its capital.
Precisely. And they define ROIC specifically here as the extra NOPAT net operating profit after tax you get from last year's investment. NOPAT's good because it strips out financing effects, focuses on core operations.
So is a higher ROIC just always better?
Generally, yes.
Okay.
All else being equal, higher ROIC means you need less investment for the same growth. It's more efficient.
But the link between growth and value is trickier.
Much trickier. This is a really critical point in the guide.
Okay, lay it out for us. Growth isn't automatically good. Seems counterintuitive.
It does, right. But growth's value depends entirely on ROIC. If your ROIC is higher than your cost of capital, then yes, growing faster creates more value. You're putting more money to work at great rates.
Makes sense.
But if your ROIC is low, below the cost of capital, then growing faster actually destroys value. You're just throwing more good money after bad, essentially.
Investing in something that doesn't pay its way.
Exactly. And if ROIC equals the cost of capital, growth doesn't add or subtract value.
Yeah.
It's just neutral.
Wow. Okay, so you really need that high ROIC before you step on the growth accelerator.
That's the ideal scenario for value creation, yes.
And different types of growth have different value impacts too, right? They used a consumer products example.
They did. It showed that typically launching brand new products tends to create the most value per dollar of new revenue.
Yeah.
Maybe less competition initially, higher returns possible.
Okay. And the least valuable growth.
Often acquisitions.
Yeah.
Because, companies tend to pay premiums, Integration is hard. Synergies don't always materialize.
The M&A graveyard is pretty full.
It is.
Mm.
And then growing with existing products, finding new customers for them, or selling more to current ones. That's usually somewhere in the middle value-wise.
Okay, so ROIC is king. What drives it? How do companies keep it high when competitors are always snapping at their heels?
Yeah, that's the million-dollar question, isn't it? It comes down to strategy and competitive advantage. A good strategy builds a moat, basically.
A moat. Okay, like what? What builds that moat?
Well, one is just sheer scale economies. Getting bigger can lower your unit costs. Think package delivery, more packages, more efficient routes.
But only up to a point, you mentioned.
Right, the guide notes the benefits often plateau.
What?
You don't get infinitely more efficient just by getting bigger. Another is a superior customer proposition.
Offering something genuinely better or unique?
Exactly. Something customers will pay more for, or that keeps them loyal.
That makes sense. What else?
Proprietary knowledge, patents, unique processes. Though they caution that manufacturing tricks get copied fast.
So maybe less about a secret formula, more about a unique way of doing things.
Yeah, like Dell's early direct sales model. That was a business model innovation, hard for competitors with retail ties to copy quickly. Then you have network economies. The value goes up as more people use it.
Like eBay or Airbnb.
Perfect examples. More users make the platform better for everyone. And finally, brand equity.
The power of a strong brand.
Huge. Lets you charge more, builds loyalty. Think P&G focusing on their biggest brands. That's leveraging brand equity.
But these advantages aren't permanent, are they? Competition erodes them.
Absolutely. Competition is always working to drive down those high returns. That's where management comes in. Good managers anticipate changes, adapt, stay ahead of the curve.
And the evidence suggests that companies can actually sustain a high ROIC.
Surprisingly often, yes. The data suggests many companies manage to keep ROIC relatively high for quite long periods. It's not easy, but it's doable.
Okay, so sustaining high ROIC is possible, though challenging. What about sustaining high growth?
That, the guide argues, is actually harder over the long term.
Harder than keeping ROIC high. Why?
Well, think about product life cycles. Products mature, growth slows. Plus, just the math of it maintaining, say, 20% growth gets way harder when you're already huge versus when you're small. The base is just bigger.
They showed some data on that, I recall.
Yeah, an exhibit showing how few companies maintain really high growth rates for a decade or more. High flyers tend to slow down considerably.
And in terms of value from growth strategies, they rank them.
Kind of. Product innovation, new stuff, usually highest potential. Getting new customers or selling more to existing ones, also good. Bolt-on acquisitions, smaller, strategic ones can work well.
And the least attractive.
Usually trying to steal market share directly from competitors, especially in mature markets, it just invites retaliation. A price war, maybe? Nobody wins.
Right. So this really highlights the need for a long-term view, doesn't it? The guide seems to stress that.
Oh, definitely. It's crucial not just for companies creating sustainable value, but for the whole economy's health. They make a clear distinction. Maximizing today's share price isn't the same as maximizing long-term value.
And focusing too much on the short term, on quarterly earnings,
Can seriously mislead managers and boards. Make them do things that look good now but hurt down the road.
what drives that short-term pressure? Is it just Wall Street?
Well, that's often the perception. Investor demands, activist shareholders maybe. Although the guide cites research saying activists can sometimes improve long-term health.
Oh, interesting. So it's not always the outsiders.
Surprisingly, their research points inward. Executives and boards often put the most short-term pressure on themselves. Internal targets, bonus structures, maybe just habit.
Wow. So we do it to ourselves sometimes. They talk about a vicious circle, too.
Yeah. A company's growth naturally slows, right?
Right.
Pressure mounts to keep profit growth high anyway. So maybe they cut R&D or marketing or training.
Things that hurt long-term prospects, but boost this quarter's numbers.
Exactly. But that underinvestment makes future growth even harder. So the pressure increases. It's a downward spiral.
And the board's role is critical here.
Absolutely critical. Boards need to understand the economics of the business, not just the accounting. And they need the backbone to support managers making tough, long-term decisions, even if Wall Street screams in the short term.
They also mention things like climate change as a form of short-termism.
Yeah, briefly.
Yeah.
Arguing that delaying action on major externalities is basically prioritizing the short-term over long-term stability and value. They note some energy companies are starting to make real moves, though.
Okay, let's shift to the market itself. It can seem, well, crazy sometimes. Volatile, Does the guide address that?
It does. They acknowledge people like Thaler and Schiller, Nobel winners, who've pointed out that markets aren't always perfectly rational mirrors of fundamentals.
Yeah. Markets can be irrational.
There can be noise, definitely. They talk about news traders who can push prices away from intrinsic value temporarily. Think the dot-com bubble.
Right. Extreme example.
But their models suggest that ultimately, fundamental investors, people looking at the underlying value, tend to pull prices back towards reality. There are boundaries.
What about accounting tricks? Does the market see through those?
Largely, yes. The guide debunks quite a few myths here, like whether an acquisition boosts or lowers earnings per share, EPS, accretion, dilution. They found basically zero correlation with how the market reacts to the deal.
So that whole game is pointless.
From a value perspective, seems so. Same with multiple expansion. In deals, the idea the acquired company magically gets the buyer's higher PE multiple. It's just math, a weighted average.
Not magic.
Not magic. And things like how companies account for stock options, or even using different accounting standards like US GAAP versus local GAAP, the market tends to look through it to the real economics.
Okay. What about the pressure to hit the quarterly earnings number, the consensus estimate?
Missing estimates can hurt, sure, but mainly because it might signal a deeper problem, a fundamental issue, or maybe management isn't credible.
But just meeting the number.
The short-term bump is limited. Fundamentals matter much more for the long run.
They also tackled conglomerate discounts, the idea that diversified companies trade for less than the sum of their parts.
Yeah, they argue that often disappears if you find truly comparable single business companies. It's often an apples to oranges comparison problem.
And company size.
Yeah.
Bigger isn't automatically better for valuation.
Not inherently, no. Once you're past a certain minimum size, maybe $250, $500 million market cap, bigger doesn't automatically mean higher valuation multiples, better ROIC, or faster growth.
Okay. And stock splits. They don't actually create value.
Nope. The positive returns you sometimes see around splits is mostly because companies tend to split their stock after the price has already gone up. It's a signal, not the cause. Self-selection.
Got it. So, given all this noise, these misconceptions, how should companies talk to investors?
The goal should be building relationships with the right investors, long-term ones focused on intrinsic value, not the day traders.
And transparency is key.
Transparency helps, yes, within competitive limits, of course. Help investors understand the real underlying performance. Interestingly, they found stopping formal earnings guidance doesn't necessarily hurt shareholders. Yeah. Performance is what drives the bus, not the guidance itself. So the message is, focus on the business. Drive ROIC. Drive value-creating growth. Don't get obsessed with the short-term stock price wiggles or hitting every single estimate.
That really brings it all together. This has been incredibly useful. Let's just quickly recap the main points.
Sure. Number one, value comes from earning returns on capital above the cost of that capital, period.
Right. ROIC, cost of capital.
2, sustainable value needs competitive advantages, those moats we talked about, to keep ROIC high.
Strategy matters a lot.
3, growth is good only if ROIC is high. Otherwise, it can destroy value. Manage growth smartly.
Okay.
And finally, think long-term. Focus on business fundamentals, communicate clearly with investors who care about the long term, and don't get sidetracked by short-term noise or accounting illusions.
Excellent summary. It feels like grasping these principles really does give you, the listener, a way to cut through the noise, doesn't it? A better lens for evaluating companies.
Absolutely. It helps you filter out what doesn't really matter in the long run.
Which leads us to a final thought for you to maybe ponder. How does this strong emphasis on ROIC and long-term fundamentals, rather than just hitting quarterly earnings targets, change how you look at companies?
Yeah, when you read the financial news or think about your own investments, how might focusing on that ROIC versus cost of capital spread shift your perspective? Does it make you think differently about growth strategies or M&A deals you hear about? Something to chew on.